Expense classifications that are standing in the way of your approval. What's number one that we see so common every single day of the week, virtually? Interest expense. Listing ancillary or miscellaneous loan fees, advance fees, future receivable fees. Anything that's ancillary and miscellaneous that's not specifically interest expense, the bank, lender, and institution, they're not going to add it back. And it might seem silly, it might seem like you can just point it out to them, but that's not the case. If it's not on its correct line, square in the square, triangle in the triangle, they're not going to add it back, unfortunately. And I've seen this for many, many years. So what do you need to do? You need to have your accountant, your tax professional, whomever, QuickBooks, you need to properly have all fees associated with the use of borrowed money, which is how the IRS defines interest expense. They need to be on the interest expense line. If they're not separated and it's in cost of goods sold, that will reduce your margin on paper. It'll make you look worse than you are. It's not correctly, you are incorrectly projecting the strength of your business because that's an eligible add back. The bank, institution, lender is going to use that to see how much of a payment you can afford. They're going to take your net income plus your net loss, plus your interest, depreciation, officer compensation. If your interest expense is hiding in one of these ancillary categories, it's not going to be added back. What's the next leading mistake we see? Not separating officer salary, owner salary, which are effectively the same, with general salaries and wages. Officer compensation is standalone, it's a deduction, it's an add back. You need to have it on a separate line. If this is blended together, which is a, by definition, literal misclassification, an institution, bank, lender is not going to consider it when they're running how much of a payment and how much of a loan you can afford. So it will reduce your repayment ability. It reduces your affordability. Not because you can't afford it, but because you've wrongfully classified it. And most accountants or even tax professionals and sometimes CFOs, they're not concerned with itemizing and appropriating this correctly. They care at year end for that reconciliation when they're making the tax filing to the IRS. That is their source of truth. That's what they care most about. We'll deal with the reconciliation at year end. Same with commonly with depreciation. So what's important? Not just have salaries and wages on a general line. If you're paying yourself, as you should be, because you need to pay yourself enough to showcase your ability to service your personal obligations, it has to be on a separate line. Officer compensation, owner salary, owner wages, whatever it is, it's got to be very specific and something that you can point out, again, so that it's separate from general salaries and wages. And that's so important because they're going to look at, are you paying yourself enough to make that living to cover what's on your personal credit report, which they will pull. And so those are the two leading impediments, I'd say, the items that stand in the way, the misclassifications. Again, if we are wrongfully putting these in other categories, you're selling yourself short. Here's another one, less common. Depreciation expense, not being listed specifically as depreciation expense. I have seen it all. It is worth noting. And at times we find out that in cost of goods or another random category, depreciation expense is hiding. It would take me too long to go through every single way I've seen it aliased, but just know and understand that if it's not standalone depreciation expense, it's not going to be added back. Now, here's something that's important to understand. If you introduce depreciation expense, meaning you reduce your depreciation because now you've itemized and reported it, you're going to bring down your profitability. So if you introduce it, you are net neutral. If you're $100,000 in net income, then you have $100,000 in depreciation, you're at break even now. But you add back depreciation at $100,000 in net income. It's a neutral impact to the overarching affordability. If you have depreciation in another category, and it's already tabulated as expense, it's being recorded, now you have $200,000 in net with add backs because you add the $100,000 in net income and you add the depreciation expense. If depreciation expense is hiding in another category and already expensed and calculated, you have just found profitability or room to fit a payment. And the same holds true, again, that same example for interest and officers' compensation. Those are the main categorization failures that I see that are most important to you. There are others, but they're less meaningful as it relates to your eligibility and your approval. So the big ones, again, recurring theme, make sure interest expense is standalone and has all of your interest expense in one line. Make sure that your officer compensation is separated from general salaries and wages. These are the leading misclassifications. Now, the last one that is worth noting, this is not just a misclassification, but it's a common theme, and it's a ask my accountant line item that you submit to a bank and lender. Reminder, you have one shot at a first impression. Ensuring that you don't have random line items that demand questioning because it creates questions across the entirety of your application. And that's very true. You can find that one irregularity can lead to more searching and analyzing in other areas of application. I see it every single day. One challenge makes them look even further at other potential concerns. So having an Ask My Accountant line item that literally means you have to go back to your accountant and ask is something you could just read down. You don't need to be an analyst or financial expert to see a line that says Ask My Accountant. Make sure you ask your accountant. And when you work with a professional that knows what they're doing, they will find this in advance of application. If you're going direct to an institution, you need to be the one that defends yourself and has yourself in the best light possible for that first impression.